Video on Facebook, part of the weekly featured stock series brought to you by the PolarisInvesting.com website. As a reminder, these videos are anywhere from 5 to 10 minutes long. If you have any questions on concepts or evaluation, calculation, you should go out and see the Polaris Investing YouTube channel, specifically the playlists on concepts and valuation calculation. Notice here that the date of this video is shown here underneath the name and ticker here on the Polaris website. The title of the video will have it does have the end appended the word suspect or prospect. Reminder: prospect means the conclusion that this video was reached that the company has good enough qualities that recommended that it be considered by the investor as a candidate, but up to the individual investor to eventually decide on their own as to whether to proceed or not with the stock. Suspect means that something has been noticed about the stock that is not being advised at this time to be even considered as a candidate by the investor. We'll get started here. We look at the practical investment return that was calculated by Polaris using the default values. So on the surface, Facebook doesn't look very promising with a 4.1% investment return being forecasted. So we'll need to drill into it and see if there might be any overrides we want to make to the default values that might change the outlook for Facebook. We'll notice here that Polaris is categorizing Facebook as being a stable company, but we will it should be pointed out that the industry, the sector and industry that Facebook is a part of is a very dynamic and quickly changing industry. So even though the company itself is currently considered stable in its operations, it is in a very dynamic industry. You notice here the price momentum, it's actually fallen relative to the overall market over the last 3 months. And if we go out and look at a little more detail here on YouTube of price history, particularly over the last month or so, Facebook, or I should say 3 months, Facebook has had a dramatic decline. And we consider the market's gone up about 3%, and Facebook has gone down almost 21%. It's obviously experienced a lot of difficulties. Been a lot of things in the press lately about Facebook and its data privacy issues, and it's like those issues are going to continue to flag the company for some time. So those are concerning aspects of the company. Well, let's go into the values that are used in the calculation. The primary value is the sales growth slider. See here that Polaris is using a 22% sales growth year over year for the next 5 years. Come down here and take the CNN link. See here that out on that side it's projecting a 36%, almost 37% growth. If we scroll up here, we look at the 45 analysts that were polled on this site, and they've ended up with quite a range of potential price targets, anywhere from 275 dropping down to 131. So 22%, and we've seen another site that's got close to 37%. There's really no way you know for sure what the sales growth will be, so I'm going to just for now assume somewhere in the middle, something like 28-30% growth. So let's go with this for now for this value, and then we get a revised practical investment return of 10.3%. So going down to the bottom, looking at other input values into the valuation formula. The issue trend, shares issue, doesn't look anything unusual for a company like this. Profit margin historically has been 32.1. See here that the forecast is 32. There has been some reports of pressure on the margins at Facebook, but I'm going to go ahead and assume that they can maintain their profit margins at 32.1%. The years of that the sales of 30% was assumed to run for is 5 years, and going to go with the default of 5 years. Cost of capital really doesn't come into play much for a company like Facebook, where it doesn't really tend to follow the market. So this calculated cost of capital based on the historical relationship between the market and the individual stock, in this case Facebook, just isn't really that relevant. So it really leaves us with one other factor to consider, and that's the PE ratio, which does require us to think through the future cost of capital, because by default the cost of capital used, because Polaris assumes mean reversion, PE is 1 plus the cost of capital divided by the cost of capital. So if we think through 15.4, or do the calculation, we realize that about 7% was used by Polaris as a default cost of capital. Now, in terms of categorizing cost of capital into this phase here 5 years from now, I've got to consider whether 7%, which is a very average cost of capital, whether we feel like Facebook will be, in terms of risk, an average company in 5 years out. And on the surface, to me, that seems unlikely. So I'm going to, first of all, raise that up to somewhere, let's do 9%. I think 9%, just a more risky type company. So what we need to do now is continue thinking through what the future PE may be if we don't assume mean reversion. Well, like I said, we're going to go ahead and assume 9% for cost of capital. Now the question is, well, what growth should we assume? Growth is what return you expect Facebook could make here 5 years out and going on forever. And then what reinvestment rate? Well, as we've talked about in other videos, that typically when you get a company gets more mature, that they gravitate to around a 33% reinvestment rate. So I'm going to use 33%. So now it's a question of how much more can they earn in terms of return over their cost of capital. That's what this return second stage factor is trying to get at. And I'm going to assume that that factor is such that the overall return that can be earned, sustained by Facebook going into stage 2 is 12%. So that's quite an increase over a 9% cost of capital. We're going to go with a 12% return. So when we plug in all those numbers into the formula, we get a price-earnings ratio of about 15.5. Well, that's very similar to just using the default cost of capital of 7% and not even thinking through of any additional sustained growth beyond that. So don't see the changing the PE in this situation. So what we're left with is a 10.3% practical investment return with a categorization of risk of around 9%. And considering the industry that Facebook is in, that's just not enough return to warrant an investment in Facebook at this time. So concluding with marking Facebook as suspect.